Hello sector watchers, welcome to the show. This is the 134th episode of Sector Spotlight, which I'm recording on the 4th of July, and obviously it will air on Tuesday the 5th of July. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. Contact details you can find on the screen. It is the first Tuesday of the month, which means that we will be diving into the monthly charts. And there is a lot to discuss, so we will only be looking at monthly charts. We'll get back to our regular overview and sector rotation segments next week. And also, as a heads up, we'll be looking at the sector rotation model after the second quarter has been completed. But for now, it's monthly charts, and we're going to go right ahead. Ladies and gentlemen, this is Sector Spotlight. Good. The monthly charts. Last Thursday we completed the monthly bars for June, and I think there are quite some interesting moves that we can discuss. We're starting with the asset classes, and I think from an asset class perspective, the main theme, the main message is coming from the bond market. You know, we're looking at the bond market through a couple of angles, and in the asset class universes we have government bonds, we have corporate bonds, and we have high yield bonds. And of course they're all bonds, but they behave differently. And the difference is in the risk that is associated with those bonds, with those particular type of bonds. Obviously, in a normal situation, government bonds are less risky. They provide the least amount of risk to an investor. The odds that a government will not be able to pay the coupon, so the interest on the coupons, or default on the bonds for governments like in the US or most European countries, that is very minimal. That's why they're considered to be safe havens. If you step up one notch, then you go to corporate bonds. That's bonds that are issued by corporations. And usually the bigger, pretty secure corporations. Think in terms of Microsoft, Intel, HP, big solid corporations, of which the odds that they will be defaulting on bonds is kind of minimal. And then the third step, or the third amount of risk, is with high yield bonds. That's obviously that's the riskiest of asset classes. Also has to do with the preference when investors are getting paid, but that is the bond asset classes with the highest amount of risk. And obviously when things are going well in the markets, those high yield bonds are very attractive. They provide a good return because these corporations, they have to pay a premium over what the government is paying to make it interesting for investors to put money with them. When things are going well, then that premium is small. That's the credit spread. That is small because the risks that are associated with those bonds are considered to be not that big. Now, when markets are getting into a more difficult situation, into a more difficult period of time, and things are getting riskier for corporations, a lot of companies have to pay a higher premium over the government bonds to make it attractive for investors to actually participate in those bonds. So the correlation between like high yield bonds and corporate bonds with the stock market is higher than government bonds do. And what we see, I think that's where a big message is coming from the bond markets right now. When we start with the monthly chart for government bonds, then you can see that last month the close was sort of on the support level. Right now at 23.90, I think that we can safely conclude that this support area, and the history of this ETF is not that long, but these are two major lows here in 2013 and in 2018. That is now broken. That is a pretty serious signal for the government bond market. This suggests that we will see more downside, which means that we will see higher yields. We could see a little bit of a pullback towards the breakout level, but I think the risk here is clearly on the downside. If we translate that to, this is 10-year bonds, so we're still in the government bond space, then we can see that 10-year bonds are resting at support. And you can very nicely see why I very often talk in terms of ranges when I talk in terms of support and resistance, because you can see that around 98, that's a low right here, and sort of clusters of highs here back in 2008 and 2010. And you see the upper boundary, that's the extreme highs that were reached in December 08. That was here in October 2010. And it's the cluster of lows here that we had in 2013 and again in 2018. So IEF found support in that area and bounced upward, where we saw that government bonds, which is the entire space, clearly broke below those lows here. If we go one notch up in terms of risk, we go to corporate bonds, we see kind of a similar picture, but here a very broad range is now broken. And that suggests that also corporate bonds are in for more downside. Again, we can't look into the future, unfortunately. We're looking at trends and we're trying to find information from the charts. And here I think that we need to conclude that this support area, which was the lower boundary of that corporate bond market from 2013 onwards, is now being broken in a downward direction. That increases the risk for further declines, and it increases the risk for further yield rises, which means that corporations need to start paying more premium for the bonds that they issue. And then finally, the highest level of risk in this chain is for high yield bonds. And you don't have to be a technical analyst, you don't have to be a rocket scientist, but this is now definitely broken support. Despite we had a little or a few sort of extreme bounces in 2016 and here at the start of 2020. But here you can see that during that month, that was the month when COVID started, we bounced back to almost 77. And then the month after, we even managed to get back up, and we had that rally into the peak of August 2021. Right now, I think for this first time, we see a very clear close below that range, and I think that's an important sign. By the way, the charts that we've just been watching are non-adjusted charts, so they are price charts. That's different from what you will see when you type. So when you type, we can change that here. When we take away the underscore, you get the total return chart for high yield bonds, which will give you a completely different picture. It still shows you the decline, but the reason that I'm using the unadjusted versions is because it helps me to identify support and resistance levels. When you want to mark support and resistance on total return charts, where there is a big component in terms of interest rate payments or high dividend paying stocks, that makes it very difficult to mark support and resistance. So please be aware that these are non-adjusted charts, and they show you the real price where these bond markets and these ETFs have been trading. So don't include the dividend payments for the ETF or the coupons for bonds. We continue rapidly. We start looking at real estate. That story didn't change too much. We completed a big, massive top there, and we're now on the way down. So I think that Real estate as an asset class is less attractive right now. And the asset class that has been doing really, really well over the last months, 2 years almost, is commodities. And I think that commodities, that's still a very good asset class, is still working its way higher from a major bottom, turning around a major long-term trend. But it looks as if it is running into resistance, and you can see here on the DJP chart that for 4 months now we've been trying to break above that 41 area. It didn't work, and we're now dropping back seriously. So it looks as if the commodity market, at least DJP, needs to go through a little bit of a period of digesting the gains before we can pick up the uptrend, which is definitely still there. If you look at GSG, kind of similar, running into resistance for 3-4 months. We're trying to break this 27 area. Didn't work so far. There's a little bit of support here. We could even drop back below 20. In percentage terms, it's quite significant, but if you look at the image, if you look at this long-term image, it wouldn't hurt the chart too much if we have a little bit of a setback and then pick up again. And then finally, wrapping up the asset classes with the US dollar chart. Last monthly close, last Thursday for the US dollar index at 104.46, which is just above the resistance area that we had here, which was 103.96 and 103.81. So we're gradually trying to break higher. Keep an eye on this. When the US dollar breaks higher, that's dollar strength, that's other currencies' weakness. Let's say the euro dollar will then continue to go down. And that's usually also not the best situation for the stock market. And that all wraps up into the S&P 500, where you can see that the downtrend here is still intact. Last month was a pretty weak month. We closed below 3,900. Looks as if new support, well, we're pitching here. This was 35.88. It looks as if we're finding a little bit of support here in that area. So there is a little bit of upside room for a recovery. But for the time being, with lower highs and lower lows in place on the monthly charts, I think that these recoveries are rallies within a downtrend, unless we see something different evolving over time during the month. The risk for the S&P remains to the downside. Well, the upside potential is fairly limited for the time being. I would say around 4,100 in the S&P 500. Now, from the S&P 500 or the stocks asset class or the asset class equities, doesn't matter how you want to call it, you know what I mean. We're going to look at the individual monthly charts for the sectors. But before I do that, I want to actually start with the table. Usually we do it at the end, and I find myself always rushing through this table, and got some messages from people say that they like the table because it contains a lot of information. So I feel that this deserves a little bit more attention, and obviously you get a little bit more attention when you're at the beginning of the discussion rather than at the end. So if we look at the table, then obviously we can see that all asset classes went down in price, except for one, and that's communication services, picked up 1.78% last month. And that's interesting because I had in the back of my mind, hey, wasn't that the one that we mentioned in seasonality as a seasonal pick? And that's right, communication services together with utilities and healthcare were seasonally strong. And definitely for communication services that worked out with a gain of almost 1.8%. And healthcare dipped only 2.8%, while the S&P went down 8.4%, and utilities went down only 5%. So I think that was pretty much in line with the seasonal expectation, so that's good news. Obviously, none of the sectors made new all-time highs, none of the sectors made new closing highs, and According to my analysis, and obviously there's a bit of subjectivity in there. What I do is I look at on the monthly chart where I think the previous highs and lows are, trying to find higher highs and higher lows on a monthly basis. That's what I do. So that means that the uptrends are now only found in energy, in healthcare, and in utilities. That's very, very limited. That's when you talk in terms of market capitalization, that's 18.5% of market capitalization. What does that mean for downtrends? There are two sectors where I have no trends. So that's for staples and that's for financials. And no trends mean that there is, it could be a series of higher highs and higher lows, and then the sector broke below the last low, below the previous low. Obviously then there is no higher highs, higher lows anymore, but it's not yet lower lows and lower highs. So that's happening in the financial sector and in the staples sector. If we look at the support and resistance levels, those are the previous highs and lows where I mark support and resistance on these monthly charts. And that gives us the downside risk and the upside potential for every sector. And you gotta read this carefully, because when a market is in a downtrend, let's say consumer discretionary, it looks as if there is a lot of upside potential and very limited downside risk. And that's true when you look at these monthly charts. But you gotta be aware of the fact that whenever you try to take a trade in that sector, and despite the potentially interesting risk reward here, you are trading opposite the prevailing trend. So if you take a long position in, let's say, consumer discretionary, you're trading against the long-term trend. There's nothing wrong with that. You can get very nice trades with such a strategy. Personally, I would have my stop losses a little bit higher, a little bit more aggressive, and I would get out probably a little bit earlier, because you're not going to put on a trend following trade in, let's say, consumer discretionary or communication services, which is bouncing right now, but it's still in a downtrend. So I hope you get the gist of it. So this is the table where we're looking at S&P in a downtrend, majority of the sectors in a downtrend, few lone rangers there, which are the defensive sectors. You know the story. That's staples, that's healthcare, that's utilities. They're holding up relatively well. So let's take a look at the monthly charts and see if we can quickly browse through them one by one. Here is communication services, resting at support and bounced up quite nicely. So we're now in the middle of that range here. Obviously the downtrend's intact, and this is where it's happening, and we got to wait and see until we got some new signals and some new clues from this market on a monthly scale, of course that is. If we go to consumer discretionary, then you can see that the move down here stalled around 1,050. There is upside potential there, but when we break further, when we break new support levels, obviously the downside is still wide open for this sector. Here is consumer staples, one of the defensive sectors, but as we mentioned last month, this is now breaking support levels. So when defensive sectors are breaking support levels, it's usually not the best for the market as a whole. Situation is still present, and we found support around 700 in the consumer staples sector last month. It's still in an uptrend. Well, it's not in an uptrend anymore. We broke this low here, so there is no trend here for consumer staples. If we hold up above 700, I consider that to be a good thing for the staples sector. Here is energy, obviously going through a big dip after a huge rise. We sort of tripled in about 2 years' time. There is still upside potential left. We are going through a setback right now, and I think I'm labeling support here in the area of that previous high that we saw in 2019. Maybe it's a little bit lower here around 460, but in the bigger scheme of things, I think this is the first one that we should monitor. And the price is now right here, 550, 545. So that's a big down month for the energy sector. Maybe the sector needs a little bit more time to digest all those gains over the last year and a half, but it remains one of the better sectors. Let there be no doubt about that. We go to financials, clearly resting at support. Here also the downside risk potentially limited with quite some upside. However, you're trading against the trend, and if we break below this level here and we drop back, then obviously there is much more downside available, and that makes it again a sector where you will trade against the trend, which is kind of dangerous or profitable as long as you're aware of your circumstances, as long as you're aware of the environment. At the moment I don't see anything there, right? But you know, this is a monthly update, so we don't know what's going to happen in the month ahead. There is definitely room for a bounce in this sector, but also in other sectors and in the S&P 500. Just want to make you aware of the fact that the bigger scheme of things, trends are still not looking fantastic. As a matter of fact, they're looking pretty grim, and you know, with 65% of market cap in a downtrend, I don't think that qualifies as a strong market. Here is healthcare. Had a dip during the month, but closed back up. So this is where the close is, around 1500, means that we're in that toppish formation. I continue to call it an uptrend because when you, for example, what I usually do when it becomes a little bit cloudy, I change it to a line chart, make it a solid line and update it. And then you can see that we're, you know, still in that series of higher highs and higher lows in the monthly scale. Hesitation here, sideways moves, but all in all, here's my subjectivity. I think that it still qualifies as an uptrend. Here is industrials. This one clearly rolled over. Now again breaking support. We're looking at around 715 probably as a new support area, and we can have different previous lows where we can mark resistance, but the trend here is very clearly going lower. The big level to watch probably around 670, but 700, 710 is the first one to watch. Here's technology. We all know that chart, resting at support around 2200, peaked below it during the month, but managed to creep back up just above 2200. Here again, you know, there is, within this whole move down, there's quite a bit of room to the upside for technology to pick up some gains. Just be aware that even if you rally towards 2500, I mean, if you look at this chart, then this is just a little, you know, low to high, new low rotation. And that's the image that is coming from the majority of these charts. Here's the materials sector. I think that of all the monthly charts for all the sectors this month, this is the clearest rolling over signal where we now have a very clear signal completing this top formation, opening up more downside risk. 440 is only intermediate, and then you get all the way down to 400. So the materials sector, and that's obviously a cyclical sector, now putting in a major top formation. Again, that's not good for the underlying trend for the S&P 500, despite the fact that it's not the biggest sector. But I hope you know what I mean. I mean, this is a large top formation, upside limited towards 490, 500, downside wide open. Here's real estate. We discussed it last month. This already completed that top formation and is now working its way lower. And here is utilities, which is holding up above 320. The defensive sector, if we hold up above 320, that's a good thing. There may be a little bit more upside there. It's still in an uptrend on a monthly scale. But again, you know, this is not the real nice uptrends that you would like to see in a full-fledged bull market. So all in all, outlook for sectors and the S&P 500 remains difficult. There's room for upside bounces, but in most of the cases that will mean a bounce within a downtrend. And I'm afraid we will need a little bit more time to turn this whole thing around. Market needs time to digest the recent gains. We're working our way lower, and it's very unlikely, in my view, that we will see like a V-shaped bounce that all of a sudden everything's forgotten and markets will all of a sudden start to rally again. Just a quick heads up that I got a message from someone asking if I could publish these monthly charts somewhere so that he wouldn't have to recreate them. And what I thought to do is to add them to my public chart list. Right now that chart list is called Sector Rotation Model, and it contains only the 4 charts of the macroeconomic indicators that back up the sector rotation model, which we are going to look at next week. But I've added the 12 charts, the S&P 500, as well as the individual sectors monthly charts. So I'll put the link in the description of this video, and you can go to that chart list anytime and look at these charts with the annotations. And that's it. Time flies when you're talking about important things. This was Sector Spotlight. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope to see you again next week at a new episode of Sector Spotlight. Same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.